ahead and introduce Chris now and let him take it over.
Would you mind cutting the lights for me?
Oh, yeah, sure.
Thank you for the intro there. Again, my name is Chris Hartshorn. I am what you call a fractional CFO, Chief Financial Officer. Give a quick background on myself, which will kind of lead into how I would say stumbled onto this profession. I started my career as a CPA with Ernst Young, Big Four public accounting. Didn't really have a passion for a specific trade, was always kind of a numbers person, so headed in that direction. Quickly found out that I wasn't an accountant, if that makes sense. However, certainly understand financials at a very deep level. Used that experience to move into business, where I worked for a technology company, a SaaS based company that did work orders on the operations side. So got some experience as a director of operations, a COO, and actually a CEO at the very end. Had a nice sale to a private equity company and exited that particular endeavor. And then moved on with my career, found myself getting engaged with early stage entrepreneurs that had raised money from VCs, and found a little niche here where I've come alongside entrepreneurs and provided finance and accounting expertise where it's welcomed. It's been a good marriage. These entrepreneurs are typically very focused on what they do, their domain expertise, and oftentimes there's some areas of that side of the house that are overlooked, some that they're aware of, some that they're not. It's a little bit hit or miss. So today I've taken my background and experience in my career, as well as what I've seen in this space, that is the entrepreneurial space, in the last 18 months, hopefully come up with an agenda that resonates with the group here. As Peter mentioned, we have a survey at the end. Please let us know if we've hit the mark here, if there's additional information, too basic, too much. We're happy to do breakout sessions on these topics specifically. You really have to just tell us what you're looking for here. I want to start with identifying what I see as the problem, and I've put a box around a statistic that I think speaks for itself in saying that over 80% of businesses fail due to proper cash flow and financial management. And just to further add some numbers to that, the SBA has calculated that there's 30 million small businesses in the U.S. Just applying some very basic math, 20% of those will fail in the first year. That's almost 5 million businesses. Half will fail by the fifth year. That's 15 million. Overall, if 80% are failing, you're talking about 5 million out of 30 that will even be around, period. So I think that puts a pretty good light on the problem itself. We'll just kind of dive in from there. One thing I did want to understand, just from the group, to understand where we're at with things. Can I just see a show of hands of who has raised money at some point in time previously? Okay. I won't go to the second question because that does not appear to be necessary. So we'll just move forward under that guide there. So some topics we're going to cover today. Are you investable? Financial Statement 101, which is, I promise, going to be a very basic understanding of what financials are. And that, when I say financial statements, I'm speaking about historical financial statements or backwards-looking financials, to distinguish between what I call forward-looking financials, which would be a budget, a forecast, something that you're projecting into the future. That will dovetail into how all of that information comes to roost for both fundraising purposes and the milestones associated with the potential fundraise, and other relevant topics in the financial management which are not limited but are mentioned here: risk, compliance, financial hygiene, and then finally summarizing it, why this is all important. We'll have some time at the end to just field questions. This is not a formal thing. Please raise your hand if you, or just blurt out questions you have. If something's unclear, please. Yeah. Are you investable? This does not mean do you have a good business idea. This means, is your house in order? Is your side of the street clean? Have you put together a pitch deck or a business plan that outlines the problem you're solving, the market that you think is available, why you and your co-founder might be the best fit to solve this problem? Pitch deck is nothing more than a condensed plan, okay? If an institutional investor is going to invest, and when I say institutional investor, I mean a venture capital firm that's looking at you to deploy significant funds, call it over $500,000. They're going to want to know that you have identified a problem, why you think you're the one to solve that problem. You're going to tell them a little bit about how you're on the road to solving that problem already, and what you're going to use the money for once they give it to you to continue that journey. If you don't have one of those, you're going to have a hard time articulating why you want money. If you have begun a business endeavor, you may have created an entity, whether that's with a state, the state of Oklahoma, like the Secretary of State, whether you've actually formally created a legal entity, maybe a LLC, S Corp, C Corp. We won't get into why you would or wouldn't do those things today. However, if you have that information, you've gone to those steps, you're going to want to have all the bylaws, the documents themselves tidied up in a specific area. The co-founders will want to have their resumes, CVs, however you want to say, outside of the pitch deck in a more extensive version. You're going to want to talk about why you're the right person to solve the problem that you're going after. If you're in business, you will want to have various insurance policies in place. Some examples could be a general, a directors and officers, insurance plan, workers' comp, etc. VCs and other investors will want to know that you have taken steps to de-risk your business. We'll explain a little bit more what that means in a bit. If your value proposition or business plan involves intellectual property or IP, have you gone to the lengths of getting a patent, getting copyright, getting the T's crossed and I's dotted, so to speak, and having all of that in order to protect yourself? We're going to want to see that. When it comes to financials, how long have you been in business? Do you have financial statements? I'll even go a step beyond. Do you feel like they're materially correct financial statements? Do you have them on a platform like a QuickBooks or a Xero? There's a few others out there, Zoho. Do you have projections? Maybe in your pitch deck. Have you thought about where your business is going and what you're doing day to day that will lead to these outcomes that are going to attract investors? If you've taken on debt, have that agreement ready to go and in what we call a data room along with the rest of this stuff, which is going to be somewhere where you can easily point investors or anyone that you want to get up to speed with your situation to a secure area. I've seen Dropbox used, I've seen Google folders used where you're assigning people to come in and have access and whatnot. There's also some other solutions out there as well. So in summary, are you investable, meaning outside of your value proposition itself, but have you checked all the boxes that will allow VCs or any other institutional investor to come in and feel comfortable that you have a professional setup and that you are serious about what you're doing. Any questions there?
Thanks very much. So on the previous screen, of all of the kind of different areas that are there, what do you see poses the biggest issue for companies where they didn't check the box and then they're not investable?
Well, I mean, for one, the pitch deck itself is a non-starter, right? Because if you don't have a valid business problem identified, there's really no point in having any of the other stuff going on, right? And in reality, I've seen, as part of the due diligence process, as part of getting that investment closed, which is not an overnight process, these types of things can happen during, right? We may change legal entity status to make an investor more comfortable. So that could take place during that process. It doesn't necessarily prevent that from going on. Even financials that are, there's some concerns. We can do some things to get those under control during. It's just, hey, if we had our way, we'd rather have all this stuff cleaned up going in and not, we want to be seen in the most professional light as possible. Did that answer that? Okay. Okay. Financial statements, who's familiar with a balance sheet? Who knows what a balance sheet is? Okay. So I assume the rest don't. But does the thought of analyzing a balance sheet, is that a scary thing to people? Is that, okay, so why does this thing exist? What is it? Okay? So I want to boil this thing down in as simple a terms as possible. A balance sheet is it has assets on it. What do people owe you? It's not 100% true, but for the most part, if somebody owes you something, or if something has future value, it's an asset. Cash is a good example. Accounts receivable, or prepaid, something you bought in advance. This has future value. We put it on our balance sheet as something we own. What is a liability? It's something that has future value to someone else, or something we owe somebody, okay? So this could be a debt or accounts payable. The difference between an asset and a liability is what we call equity, okay? So that, hopefully that's in a position where we're positive, meaning we have more things we own than things we owe. That's called equity. Maybe some of you are familiar with a house as an example. If the house is worth more than what you owe, you say, I have equity in that house. It's similar on a balance sheet. The assets, or what has future value, if it's more than what you owe people, you have equity in your business. In this example, we have $140,000 of total assets, $60,000 of liabilities. That means that we have $80,000 of equity or book value in our business. I will pause here to distinguish between the fact that the books say we have $80,000 of net value, which is a totally different conversation than what our business is worth, or what a VC or the open market would value your business at in a transaction to buy it. This is simply just a ledger. So, for those of you who are somewhat unclear about a balance sheet, are we now more clear than we were 5 minutes ago? I know you shook your head no before. Is this helpful?
Yeah, I've just seen ones that didn't seem to add up, but my accountant seemed to make it able to.
So you know more than you think. This should add up. It may be incorrect. Okay? But these things should balance. There's no reason that they shouldn't balance. Accounting principles tell you when you have a debit or the left side entry, you have to have an equal credit or opposite entry. There is no misbalanced entry. Something has not happened properly. If this equation doesn't work, assets minus liabilities equals equity, there's been an error. This is not, no one's inventing a different way to do this. Like this is the way things are done. So a snapshot in a point in time. This will change next month, next quarter, next year. Okay, this is a point in time. Typically we look at these at a month end, we look at them at a quarter end and at a year end. We may compare against prior periods to understand maybe what's changed. Okay. Profit and loss statement or income statement is the second of 3 financial statements that look in the rear view mirror or look backwards. An income statement is how well you operated in a period. It's not a point in time, it's a range of time. It could be a month, it could be a quarter, it could be a year. This tells you how well did my business do, what did I sell in a given period, and what were my expenses, and ultimately, did I make money, did I lose money? It's typically going to be one of those 2 things. What you're selling less the cost of what you're selling, whether it's a service or product, is what we call our gross profit, or you may have heard terms like gross margin. Oftentimes when people just say margin, they're referring to this. This number is 60% of the revenue, meaning for every $5 that we sell something, it costs us $2 to sell it. Expenses below gross profit, or what we call operating expenses, you may have heard terms like OpEx. This is not an extensive list. I'm putting just some very common terms here. Salaries and wages is probably going to be your largest expense, especially in early stage tech. Rent could be an expense. If we're fortunate enough to be officed here, it's lower than what you might have to incur if you're out in the marketplace. Some of you may be familiar with AWS, Amazon Web Services. If you're building a platform that's out on the web, this may even be a little light for how much that costs. You guys might have a better idea than I do, but that is a common expense that would be out there on a P&L for a tech company. And then of course, I can't leave subscriptions out, right? We all love subscriptions. We want to sell subscriptions. We also subscribe to platforms like accounting services and a whole host of others. I won't go into any sort of tax implications, but basically what comes in less what goes out is what we call our net income or loss before tax. Any questions?
So this looks like what's on your tax return. Is this what that's called, right? Profit or loss?
Yes and no. There's a couple ways to do, have you heard of accrual basis financials and cash basis?
Yeah.
So tax is typically cash basis, means when cash changes hands is when the transactions take place. Accrual is a departure from that. Have you heard of the term US GAAP? United States Generally Accepted Accounting Principles. So the concept there is, I think, a little bit beyond where I want to go in this particular session. However, there could be a reason why this would be different than what you see on a tax return, because of an election you have made on the method of how you're accounting for something. Yeah, we could do its own session there. You would have to have coffee at that session. Not necessarily be fun. Okay, the last of which is the backwards-looking financial statement is going to be your cash flow statement. This is a reconciliation between your starting cash balance and your ending cash balance. Again, this could be 1 month period, it could be a quarter, it could be a year. But it tells you what was my cash, where did it end, and how did it get from that point to the end. And we typically look at it, there's 3 main categories called operating activities, investing, and financing. Operating is as it sounds. It's how did your business do? Did we make money? money? Did we lose money? What were the results of your business? Investing, which is probably least applicable of the three, is did you buy any machinery, which again is not really applicable in tech. And also, hey, we have excess cash, which also doesn't seem to be applicable to tech, which we're investing elsewhere. So we have proceeds from investments we've made in marketable securities. Financing activities is highly applicable to this room, meaning did we have proceeds from issuing debt or equity, or did we pay back debt, or did we buy back someone's stock, which is called a treasury stock repurchase? What funds came from that? Ultimately, the addition of these three categories will reconcile the difference between our starting and our ending cash balance, in this case $88,000. Clear as mud? Okay.
I have a really quick question on purchase of equipment. My business is not tech. I have a service,
Yeah.
and that service requires instruments. So like those instruments are not something I'm selling, but it's something I would want to continue purchasing to expand my service.
Right.
So would that count as an investing item?
Do these, tell me more how this helps you provide your service.
So the service is a sound bath. So the instruments are sound bowls, gongs, chimes, tuning forks. Like any instrument, like depending on the quality and whatnot, like they can get really expensive. So that is something that would be, in my eyes, an investment to the business.
And do they last years?
Yeah.
Yeah. You're exactly right. This would be a purchase of an asset that has extended future value. That would be something that you're putting in your investment.
And then this might be not a one-on-one question, but like, do those depreciate, appreciate?
Yes.
How do you assign value to an instrument?
Yes.
There's
Yes. Another class, but no.
Okay.
There's a different way to do it in the tax world
Yeah.
versus GAAP.
Okay.
But yes, you do depreciate it down over time.
Okay.
It's not enough for the tax class, I think.
Either we need a tax
Yeah.
class, which is where we're going.
Please.
Did you have another question, or?
Yeah, so with that, if you have like instruments like that, and for some unfortunate reason, you are liable or going out of business or need to liquidate, because it's on there, you would have to like prove its value or something, or like sell it, if you had like IRS debt or something. I guess that's still a tax question, sorry.
It is a tax question. I hope no one's kind of into that particular situation. However, these instruments we're talking about as it relates to financial statements would come on at the cost that you bought them. And then you would have an account that is what we call a contra account or negative that over time depletes it down. You would see that initial cost as the same generally.
Okay.
For the 101 class, I'll stop it right there. Yeah. I like these questions though. You guys know stuff. Okay. That is, so what we've talked about so far is going to be backwards looking, or the results have already taken place. We're just simply scorekeepers, just recording what has happened. Okay. So now, what I think is kind of the more interesting part of all of it is either things we can look at that are applicable today, or things that are going to be applicable to us in the future based on how we want to handle things in our business. VCs or anyone wanting to raise money will likely be tracking their cash position in what we call a cash burn calculation. Okay, cash position is exactly as it sounds. It's how much do you have in your bank at a point in time. So you can get that off your balance sheet. You can go to your log on to online banking and how much cash is in there. Okay. The cash burn calculation is, I have a little graphic on the side here that will kind of depict what I'm talking about here. It's typically in a startup, you're having more money go out the door than come in the door on a monthly basis. So if you take your cash position divided by the amount of money that goes out the door on a monthly basis, that would be your cash burn. So the easy example, we'll get into a little different way to look at it. If I have $500,000 on hand and I'm losing, or I have net outflow of $60,000 a month, I have 8.3 months of cash remaining. So I'm burning $60,000 a month, and unless something changes between month 8 and 9, I'm going to be out of cash. Simple enough?
Go ahead. I was just gonna say, so you said net outflow, so then are you accounting for any cash that is produced during that time, and then?
Yes, the next slide will be a graphic of, yeah.
Wait, let me see.
I have a quick question.
Yeah.
Are you considering credit spent or credit incurred as cash or no? It's a bill, not cash.
It's typically operating on a cash basis. Yeah, so we're not, is it payable? The payables question, like
Right.
we
Yeah,
got the
just like where
invoice,
would
I'm
that
not gonna
go
pay it for
versus-
months on end.
Yeah. If I'm not able to pay that, like let's say I put purchase equipment on a credit card and on a debit,
Yeah. I'll address
is
that.
that part of cash flow?
I'll address that. So this will depict cash burn. What we have here is a starting cash balance. We have what is our inflow, which we'll just call that revenue. We sold something for, in this case, Q1 of $14,000. However, we had $45,000 of outflow. The math here tells us what we ended at. So our ending cash balance divided by the net burn, which is $31,000, gives us a month's remaining of 8. Right? Does everybody follow that math? This divided by that is 8.
So, it might be still your future thunder here, but like, what's your best practice for startup? Do you guys keep, a 1-2 year cash flow forecast, or at what point are you spending too much time in a spreadsheet?
Can I kick that down the road? I definitely am going to be going over that. So, can anybody see anything wrong with this, or analyze like problems with this particular cash burn analysis? I mean, it's correct, like it's mathematically correct, but like what looks funny here?
The outflow varies so much.
Well, so it's 5 months, and then it's 24, and it's 7, and
Which one
it's
is it? We got forever.
right. Like, how do we make decisions? We're all over the place, right? And I did that on purpose because typically you don't look at this thing as just a siloed month over month. Typically, we would look at it more of a trend. What is our net outflow on a trailing 4 months, 5 months, 6 months? Something to smooth out these bumps so that we get a more realistic figure of what we have left. So that's certainly something I want to point out here. Also, I wanted to point out we fundraised in Q3. However, that factors into our ending cash balance. However, that does not factor into our burn. That is not something that that is part of our business that we're going to rely on to keep us afloat. So you can see the summation here, or negative 10,000, that math gives us 24 months.
And you said those, like a credit expense, credit purchase would go under expense. Like essentially only if it was paid.
Right. So if we had
Period.
a $20,000 loan, debt, or hey, we financed something in some regard, our monthly payment for it is $600. $600 is our outflow per month, and there'll be a larger example that'll have one of those on there too.
Okay. One follow-up question to that.
Yeah.
No, never mind. No question.
Good. Managing cash flow. Again, we're looking on a forward basis here. When I say the word budgeting, does that excite anybody? Does that sound like something that's pretty dry? And does that sound like fun at all?
Can I get a photo of the last slide?
Maybe you and I need to talk.
She's an accountant.
I can just go down the rabbit hole.
Sorry, can I get a really fast photo of the last slide? I missed it.
Sure, and I can send this to, I can send this out.
Thank you.
You want me in it or out?
You're good. I'm gonna give you.
Okay. A budget, in its simple terms, I didn't even look this up, but it's just my definition of a budget is simply the financial outcomes of your plan. You think you're going to do X, Y, Z over the next 12 months. What does that look like on the financial side? What money's coming in? What is our spend going to be over the next 12 months? We have the information that we have today. We make decisions based on what we know today. Can things change? They can. We'll kick that down the road as well. We make a budget typically in Q4 for the next annual period. And the reason we're doing that is we're planning for what's going to happen in that period. And as part of that planning process, we're making decisions like how much do we want to put in our marketing spend? What are we going to emphasize or de-emphasize based on the trends in our business? Ultimately, unless information changes, a budget is a good vehicle to keep you accountable to the spending that you thought was reasonable when you made the budget. Okay? In juxtaposition to a forecast, which is typically something we're using for strategic purposes, where we're looking at, say, 2 or 3, no more than 4 scenarios of what revenue might look like, or even cash burn is technically a forecast, something out into the future that we could have a couple different versions of how we think that could play out. Forecasts are something that you may revisit it quarterly depending on how things change. Forecasts are something that VCs and other investors will want to see. They want to know what you think your business is going to look like in 3 to 5 years. Part of your pitch deck will likely have projections in it. We think there's a problem, we're the right ones to solve it. We think there's a market, here's how we're going to attack that market, and here's what the revenue is going to look like when we execute. And here's best case scenario, what we call base case or most likely to happen scenario, and then kind of a not doomsday, but like downside type scenario. I would say outside of those 3, there's probably less benefit than you think you're getting. Do I need a budget or a forecast? I would always answer it as yes. You may recognize some of these people as yourselves or somebody that you know. Hey, what am I feeling? I don't know how long I have. People have asked me for a budget, but I don't know how to produce it. I think I'm spending too much, but I'm not quite sure. I have a gut feeling about something, but I'd feel a lot better if I had something that was a little bit more solid. Maybe you recognize these folks, maybe you don't. So some basics of budget. Again, it's an accountability tool. Typically, it's over the next 12-month period. You're doing this in Q4. So for example, Q4 of 23, you'd be budgeting for 2024. Inflows, outflows, what do you expect to come in versus what do you expect to go out? If you don't know where to start, download your bank transactions from Bank of America, whatever you use. Look at what
Region Bank.
Region Bank. How did I drop the ball on that?
That survey is gonna be rough, buddy.
Yeah. The preferred tech banking provider, Region Bank, would allow you to download your transactions, which you could then understand, hey, this is where I've been. What's changed? Am I going to continue on this path, or have the inputs changed where I expect different results? That's a good way to start. For budgeting purposes, you may think, hey, I've got some large outflows taking place this year. They're one time. We call them CapEx or capital expenditures. They have benefit over multiple periods. We've had some questions asked already that relate directly to this versus what is more frequent but smaller, like my rent and my weight. It's consistent. Those are operating expense outflows. Are they fixed? My rent, it's fixed. What's variable? Maybe my utility bills, if you have them, or AWS. It's based on how many people are clicking around in your product, and you see some variance in that month over month. That's something we might want to look at over time and see what is an average, how much does it cost on an average, and then we'll load that into our budget. We may want to do a sensitivity analysis or plan for certain contingencies by removing certain large figures or certain things we feel less comfortable about to see what does it do to our cash flow. Is this going to be detrimental to us or not? And finally, if you have other co-founders or senior level members of the team, make sure you guys all do this together. You want to make sure that they're bought in and that they're part of this process, so when we hold people accountable to a budget, they aren't maybe bitter about it. More extended version of we do have cash burn here, but of a budget. I'll walk through the basic mechanics of it. We've got cash on the top, which then comes down to what do we think is going to come in, or our inflows, collections, what's going to go out, what's the net of that amount, and what does the math do to the ending cash balance. And then furthermore, the cash balance divided by our outflow is our spend remaining. So somebody help me out here. Just point out a concern on this budget, something that to be aware of.
Got way too close to running cash.
That's right. So we've put in a $200,000 financing inflow in September, and as we see where this number is getting closer and closer to zero and only gets higher because we raise money. If we don't raise right here, we could be in a cash crunch, okay? That's not something you would want to figure out right here. That's something we probably figure out actually more like back here somewhere, because we're running these on a monthly basis. And if we're doing sensitivity, we may remove that just to see what happens if that doesn't come to be. All right? So we had a question earlier about we finance something and we have a monthly outflow for that financing. So this could be debt we took on that then translates into money out the door on a monthly basis, where we've got a $20,000 loan and the interest for that becomes $400 a month. Notice that didn't come on our budget until we borrowed money. So from a cash burn perspective, we're only factoring in the $400 a month interest payment.
So if I open a line of credit that's worth $12K, does that go on that month that it was open as an influx of available cash?
It's not. You could look at it that way. You could. It's available to use.
But you wouldn't actually put something in the interest until you draw down the line of credit.
Right, but if you want to say, hey, I've got $12,000 available to me, and it's not showing in this representation, quotation, you could put it in there if you wanted.
Or would it be better to put the cost of the purchase, say it's only $1,500, and I've got $12,000 available on that credit line? Am I entering like the month that I purchased that instrument, the $1,500, and then the payments go down here? That's like what
Yeah, I mean, the two are gonna coincide, right? When you bought the instrument, you drew down on the line, so cash would go up, and then the exact amount would go out to buy the instrument.
Okay,
Right? So it would
yeah.
kind of be a wash in that respect. However, you'd be left, you just drew down on something you're now paying. So your version of this
Yeah.
would have to be, at that point in time, if you thought, I'm gonna make that purchase in late April, starting in May, you're gonna wanna factor in what your monthly outflow is for that particular purchase.
So you would not put it as like the full amount as outflow for that month?
No,
Yeah.
nope. None of these factor into this calculation. It's simply what's happening in your operations. Okay, part of the reason we do a budget, I've mentioned it a few times, is for accountability purposes. So what we're doing on a recurring basis, I prefer monthly, it could be quarterly, could be annually, but we're comparing our budget to actual results. Did what actually happened match up with what we thought was going to happen? If yes, great, and hopefully it's all good stuff. If not, this is a learning opportunity, because if this costs you more money than you thought, let's get something good out of this. Why did our results not match what we thought was going to happen? Has something changed in our business? Do we need to look at things differently? Why did this happen? And then use that information for good going forward. Is something not working? What were your successes or failures? Or even if, as you start getting larger, is it a certain team member or department that continuously has problems meeting those budget amounts? It's going to tell you information that you may want to take action. Tips, start the process. That's the most important thing. What you do day one is going to be different day 2, day 3, day 4. Get something down, start using it, see what's working, see what doesn't. I would recommend doing this annually. Have a cash burn calculation factored in. Understand where your cash low point is, and then do a comparison. Forecasting, up and to the right is really the secret sauce. Just make sure it's doing that. You'll be fine. Some say hockey stick. That's even more aggressive. However, in all seriousness, when you're raising money and you're trying to tell a story, you're a co-founder that's passionate about what you do, this is the outcome of what you're trying to sell people on. Is, hey, I believe in the fact that there's a market, I'm the right person, all the numbers are aligning. You should have a forecast that is trending up very quickly. Could things happen where that wouldn't be the case? Sure, but if you're going to attract venture funding, they have to know that there is the potential of this being the home run, to use a sports terminology. There's different ways to look at it. Market comparisons, applying a growth rate, doing some, we won't get into regression. That has to do with having data from the past that you can connect, meaning because A happened, we feel like B is related to A, and over time we can understand the way those two are connected. It's a little bit much. Again, 2 to 3 of the forecast is plenty. Change some variables. See what lower sales does or higher sales, but don't get too crazy with it. Typically, you're going to do that 3 to 5 years out. Refresh it quarterly. Don't need to get too crazy with that. Going the wrong way. Okay, so some examples. This is like a 9% growth curve. The blue being what happened that month, and then the orange being the cumulative. So there's two sides of this graph. This is the monthly, and that's the cumulative. So the two have been put together. Between the two, if the two on the top are related to revenue, what's the problem with either? Any concerns with one or the other?
Can you ask a question?
So the two on the top, exponential growth and S-curve growth, like which one do you like? Yes, because if I'm in a room with a VC, what story am I telling about the one on the right?
Make less money at some point.
Well, so I'm supposed to explain how my business is plateaued and kind of going the wrong way? Like, that doesn't match the story that I'm trying to excite somebody about, that this is a space that you need to be in and you need to invest in me, and I'm the one to do it. I'm showing something that looks more like the one on the top left. The bottom is a cash burn graph. I'll send that to you if anybody has interest in that. Don't overdo it with forecasts. 2 to 3, maybe even just 2 is fine. We've hit that one pretty hard. Milestones in fundraising. Does anyone know what that is in the top right? I've been waiting for this one.
Boxcar racer?
What was the guess?
Boxcar racer? I've played it, I can tell you the name of it.
No.
We had it on.
I might, man, okay. Does anyone know like pole position? Has anybody heard of that game? Does anybody know what Atari is? Okay. Atari? Okay. So pole position is a game where you're trying to race against a clock and you only get more time if you cross a finish line that gives you more time, and then you're racing to again cross the finish line that gives you more time. This is my analogy for fundraising in the VC space. If you have fundraised, you're likely to fundraise again. Let's call that period 18 to 24 months. And between then and here, you need to get to that next checkpoint before you run out of money, or in this case, run out of time. There's a lot that has to happen in between here, and I am acutely aware of the situation because of my client base for the challenges in the middle between having raised money and then raising money again. And I think it's even applicable to the fact that people in this room haven't raised money. If I'm going to raise money in 18 to 24 months, what does my race look like between then and now? Because in my opinion, it's not being well measured, and there's almost people are getting to the end of this race and wondering why they've run out of time, and they've been behind that wheel the whole time. So what I'm trying to say here, using my Atari analogy, is understand what's important in your business, measure that, and if you're not on the right track, then pivot. However, be measuring. Be measuring this entire time what you feel is important. Because we're short on time, I'm going to blaze through some of these last few that I think you can read through and get the gist of. I'm happy to send this to you. Other things that I've seen, I call this an orphan slide because it didn't really fit anywhere, but just things I found to be helpful is, as it relates to financials or what you do on a monthly basis, it's much easier if you use a platform. Document this process. And I say this knowing that things change so quickly in the startup space, but what you do monthly doesn't change. What you do to review your financials, the key performance indicators you look at, this is all the same each month. Understand that process and stick to it. Maintain your budgeting cycle, define terms. People will say they're measuring cost to acquire a client, and they'll do it in a way that is not standard. Maybe it makes sense, but tell us how you're calculating something. Don't make up your own way to do it and not tell anybody about it. Spreadsheets, this is a pet peeve of mine. If you're gonna build a model or use spreadsheets, please use formulas and cell references. Because if someone's trying to find your elaborate model that you've spent 4 months on and you know in and out, they're seeing it for the first time and they can't trace through what you're thinking. So the more that the stuff's connected, the better. Maintain quality documentation, leverage consultants. Cash is king right now, so being able to work with somebody like Peter and leverage him, or even on the financial side, someone like myself that you don't have to hire full time, has benefits that are financial and otherwise. Okay, so in the prompt for you guys all to be here, I think it said something to the tune of, hey, financial management is going to help you grow, right? And so my intention here with the slide was that I'm going to summarize why I think financial management will help you grow. And the big item that sticks out on this slide to me is just the fact that you're going to be around it all, right? If you have an 80% chance of failure, but have strong financial management principles, that means that you right there will even have a chance to grow because you will be around. And if you mismanage yourself, chances are you won't be around. Okay? If you understand your finances, you're going to extend the life of your company. Your pole position gain, your clock's going to be longer. You got more time to get to the next gas station or the next time extension. It's extremely important when you're trying to figure things out as you go. Making yourself investable. If you don't do these things, you don't have a chance to get money from somebody because they're going to assess you as too green or too immature or not ready for investment. Don't give them that out to say they don't want to invest because of those reasons. What I've talked about today will keep you accountable. It will facilitate decision making. It's a forcing function to understand that what we're doing day to day has financial implications. And finally, de-risking the situation, which is a buzzword that VCs love as well. Okay. That was a bit long, probably too many slides, but if you guys wouldn't, we'll do Q&A, but get your smartphones out. Please take the survey. Peter did a nice intro at the beginning, but I do want to thank Peter for having the lunch today. He is with Region Bank, the bank that believes in you. So if you have questions for Peter or myself, I'll certainly be around for a little while here, but happy to take questions as well. But as Peter mentioned, we want to do a series of basically what's important to you, and we can only know that if you tell us what's important to you. I also personally, I need to know if my slides resonated, if this was too much, too little. If you want to know more, please just scan that QR code. I can send you this deck if that's important to you. Please let us know how we did, but we do thank you for your time. I know it's valuable, and hopefully you all found it valuable as well. So, questions? Yeah, go ahead.
Yeah, I was going to ask, so, some of the processes that you mentioned, financial hygiene, et cetera, is there a particular dollar amount at which you would have a CFO or fractional CFO come in and also to start implementing some of those processes? Because like a seed or pre-seed company, I feel like this would be kind of overkill.
Yes.
So I'm wondering if there's like a dollar amount or a particular juncture at which you say this is the best time to implement.
I would say the action or the trigger for even a fractional CFO like myself is probably like you're going to be raising money imminently. Like when I say raising money, call it $1 million+ or have already done that. Okay. If I think with where most of the people in this room, one, I'd be happy to just have a conversation with you to provide you information and guidance, but I could also see one-off projects and like, hey, let's go through an exercise to get you on the right path, but it's just kind of a one-time thing. We would have to figure out the exact kind of situation. If this stuff all makes sense to you and you have the bandwidth to do it, by all means. I think the other trade-off that I see often is not that co-founders don't have the ability to do some of these things, but you only have so much time, and what's the highest and best use of your time is you're trying to solve your business thesis, and then there's this other financial stuff over here that kind of takes away from your ability to do that.
The other question I was gonna ask is, I feel like there's a pretty critical distinction between small business and high growth venture and startup. Of the stuff that you shared, what do you think is like small businesses can do to kind of like, obviously budgeting being one, but is there, of those ones that you shared, what do you think is the biggest overlap for small businesses, which should we need?
I would say that it's very different, really. I think it's important to know why you're doing these things, and I used venture capital many times in my discussion here. They have goals which may or may not align with the co-founder's goals, right? I think about what we call lifestyle businesses or entrepreneurs that are self-funding their growth may do that in a different way than people that are trying to grow in a more rapid fashion. There's different goals and ways to accommodate that. However, the principles don't change, right? Maybe the dollars change, but you want accountability under all scenarios. You want to match what you think is going to happen to financial outcomes under any scenario. We can't escape financing accounting. It will always be there. Everything will boil down to numbers. Yeah.
Two questions for you, kind of overlap.
Let me get around this motor.
I'm curious, how much, like how many months of runway do you recommend for cash bank account? And then, kind of to add to that, is there a percentage? Let's say you meet that runway, and then beyond that, with the excess, like at what point do you recommend looking at CDs or money market accounts or or lines of credit? Like, what are your thoughts on that?
So that to me boils down to your strategy. Okay, if you're in high growth mode or home run potential mode, where in the short run you're what I call hemorrhaging cash, or you're having a lot more outflows than inflows, understand that for that to work for you, you have to be able to raise money again, because so much is going out versus so much is going in. Now, if you pivot your strategy to say, are we able to be self-sufficient right now and extend our runway, then maybe you might consider doing that. I don't know if I answered your question, but I hardly would ever consider going to CDs or money, because usually the cash is needed to be spent somewhat in the short run, and call the short run in 12 months or less. You did ask about runway.
So some banks, I'm pretty sure Region does, but some banks for small business checking accounts now are even offering like 1.5% APY. Some are doing like 3 months, 6 months CDs. And so I ask because, some people say like you should keep 3 months of runway, you should keep 6 months of runway. And I think that's probably preference.
Yeah.
Like, what's the minimum?
Yeah.
And if so, would you want to just put that in a CD, or would you want to?
Yeah, I'll let him address any sort of specific banking products available, but when I say how much runway do you have, whether it's in a CD, a savings account, a checking account, whatever account, to me that's cash. How much cash do you have? Because whether you're using the most liquid stuff first, you're gonna get to the others when needed. We wanna know what's available to you and what you have left. When you say how much burn do you recommend, as much as possible, right? I hope that you never have to have a cash burn calculation, meaning more is coming in than going out. You don't want to get to, if you're starting to hit, hey, I got 8 to 12 months remaining, you should be like, where's funding going to be coming from? If I need external money because my business operation isn't funding itself, and you're in the 8 to 12 months left range, you should really be knowing or planning for where that next fundraising is gonna come from.
You're mixing your question up, in a lot of these principles, because so think about it as, you get all your statements in order, your cash flow and all, your budget and your forecasting, okay? And you let that kind of determine how much cash you want to have on hand, and then maybe how much cash you want to have in a CD, because you want to take advantage of better interest rates by not having, all your money. So if you do all your statements and your business is kind of operating, steady state, you're growing at 10%, you'll figure out kind of what you need to do based on how the business is going. And are you forecasting any big changes? I'm gonna need to hire somebody in 6 months' time, okay? So I know that in 6 months, I'm gonna have an event that I'm gonna have to fund, okay? So you kind of let your business plans kind of determine that. It may change over time. But you're talking about, treasury management. How do I manage the cash? You have to look at your cash flow forecast to determine what is optimal for you. And then you can run some scenarios on that, or have your banker run some scenarios on that. Because they can look at, good treasury management person capability will help you do that. Help you manage your cash flow and optimize the interest that you get. So the answer is always going to be, it depends, okay? Tech business, obviously, high growth, high risk, high cash burn, all those other kinds of things will be different than, say, a non-tech business, which is considered more of a small business. Your revenues might be a little bit more predictable, and your situation might be more predictable. So, talk to your banker, for sure.
But you will likely need access to the funds. You have to weigh, okay, is this what likely is a minimal interest rate gain for not having access? May not be worth a slightly less return, but you do have access.
I've got 2 separate bank accounts. One's JP Morgan Chase, one's Harvest. One's a big bank, one's like a regional, smaller bank. Most of our operational cash sits in Harvest, and I equate it to about 10% of annual revenue sits there. It just sits there, right? So like, it's not really operating cash. It's just, and I kind of wonder, like, so if I didn't have any revenue for the next 3 months, I could still burn, it'd be okay. But after 3 or 4 months, I might, need to start making something, right? So I kind of wonder, it's like, what's the threshold? You want to get that to 6 months? Do I need to build up that account so that's like 6 months, and if like all the faucets turn off tomorrow, and it's just burn, so I don't know.
Well, none of what I'm trying to describe today is like surviving. If you're just surviving, then there may be some other things we want to look at on your business plan and things like, why is your revenue completely turned off? Like, that would be my question. Like, is that even a realistic doomsday? Right? Like, you may be the guy that's doing this, like, too many scenarios, stuff that isn't really realistic. Like, okay, low revenue months, sure, but no revenue months. I mean, maybe you just look at what it would be and then leave it at that. But it doesn't seem like a realistic situation.
So that ties into, it is more like a scenario question. It's not my problem, but at what point, if you have only 1 or 2 months left and you're not raising any funds, what counts as a business failing? Because you can be in debt, did it fail? What actually counts?
But why are you even in that position?
Right, but I'm saying, I want to know what that looks like. I'm not in that position, but I would want to know, is it when you have 6 months left and you don't have any investor coming in, that's when you know? Is it 3 months left? I think it's kind of the inverse of this question.
Well, so I think this may be kind of a grander scale situation, but I have a client that was on the VC home run trajectory path, and they raised at a time where it was not like it is now, which let's call this a contracting, tightening economy. let's say the company didn't quite do what they say, they failed a little bit, and now they're not looking as attractive to investors. So they're saying, no one wants to invest in us, we're burning a lot of cash. We can see the end of the game right in front of us. So what we did with that is we shored up their expenses, and we have a plan to get them to profitability with what they're doing today. Not to expand geography, not to expand product lines, but to get their flagship product under control today, get cash flow positivity, live to fight another day, wait for the economy to, when investors are more willing to invest, and then they're going to pursue their home run situation next year or the year after. But they've been able to figure out how to shrink things down to make a business cash flow, let's say, when I say today, like in the next couple of months.
Meaning there will not be a burn.
Meaning that, correct, at some, they're getting towards zero, and then we project that they're gonna come out of zero.
And I think there's also needs to be like a clarification also, like there are two different types of companies, right? You spoke about like a lifestyle, right, where somebody's just sitting down and you're just trying to, make money for yourself and maximize profitability, right, and grow. But it sounds like a lot of your lens is speaking from a tech startup where it's like literally it's our job to burn cash, right? Well, not to burn it, but like to grow profitable and raise it. Is there?
Well, yeah. So, how many of you are involved in building some sort of platform? Okay, so
Platform as in like a software?
yeah, software platform. Okay, so engineers aren't cheap, right? So if you want to build a platform, and let's say you need to hire 3-4 engineers, and your revenue is dependent on that platform being available to the marketplace, well, expenses are going to come before the revenue, right? You need to have money to be able to hire these engineers to build your platform to operate your business. And that's going to mean that in that initial period, you have probably high cash burn, just simply from salaries and wages to pay the individuals that are building this platform out, right? And if situations change, you may need to get rid of some engineers, cut off your product development, maybe it's ready for market because it's got 2 out of the 5 feet. That's up to you to decide, and that facts and circumstances. Yeah.
So in this situation, like one thing I think is unique is when I have 2 questions. So I'm working with kind of like the VC world, right, where they're raising money all the time, and of course money's going out at a high level. I'm interested in at what level does like employee benefits become relevant? You know what I mean? Like where, like, hey, we raise, clients are asking, or employees are asking about, 401k or medical insurance. Like, when does that line come in? And then my second question is, when as an investor should we be expecting a company to have this ready? Like, you know what I mean? Like, when should somebody look at a company and be like, okay, kick out all these financials, and we should expect it readily available like that?
So the first question, in my opinion on that is if you're in on the early stage and you're one of the co-founders and you're incentivized by